Let's say your investment portfolio goes up 10,000 euros this year. You don't sell, you don't cash out, you don't touch a single share, and the Dutch government sends you a tax bill for 3,600 euros. That's not a hypothetical. That's the law the Netherlands just passed. Starting January 1st, 2028, Dutch residents will owe 36% tax on paper profits from stocks, bonds, ETFs, and crypto, even if they never sold a single asset. And here's the part most people are missing. This isn't just a Dutch problem, because if one government can do it, others are watching. Right now, several European Union member states are studying the Dutch model. Today, we're exposing exactly how this tax works, why the Dutch government pushed it through despite knowing it is deeply flawed, and what this means for every investor in Europe, not just the Dutch. To understand why this is happening, we have to go back to December 24th, 2021, Christmas Eve, and the Dutch Supreme Court dropped a bombshell. For decades, the Netherlands taxed investment income using something called the deemed return system. Here's how it worked. The government did not look at what you actually earned. They assumed you earned a fictional rate of return between 1.8% and 5.5% depending on your wealth bracket, and they taxed you on that imaginary income. Good year, bad year, they did not care. You owed tax on a number made up by a spreadsheet in The Hague. In 2021, the Supreme Court ruled this was unconstitutional. It violated Article 1 of the First Protocol to the European Convention on Human Rights. Taxing people on income they never received crossed the line. Now the government had a crisis. Every year without a replacement system cost the Dutch Treasury an estimated 2.3 billion euros. That is not a rounding error. That is schools, roads, public services. Lawmakers had two real options. Option 1, build a proper realized capital gains system, like Germany, France, or the United Kingdom, where you pay tax only when you sell. That would take 4 to 5 years to design and implement. Option 2, the quick fix. Tax unrealized gains right now. They chose option 2. And here is where it gets dark. Here is how the new system actually works. The Dutch income tax system divides personal income into 3 boxes. Box 1 is employment income. Box 2 is income from owning at least 5% of a company. Box 3 is everything else, your savings account, your brokerage, your crypto wallet. Box 3 just got overhauled. Under the new law, Box 3 taxes actual returns at a flat 36% rate, but actual returns now means something it never meant before. It includes unrealized gains. Think about what that means. You hold 100,000 euros in a stock portfolio on January 1st. By December 31st, it is worth 110,000 euros. You owe 36% tax on that 10,000 euros gain, even if you never sold a single share, even if that money is still locked inside your brokerage account. There's a small exemption. The first 1,800 euros in annual returns is tax-free. Anything above that, the full 36% tax kicks in. If you have a bad year, you can carry losses forward indefinitely, but only losses exceeding 500 euros qualify. The government built in a floor to protect itself from too many small write-offs. Now, here's where the hypocrisy starts to show. Not all assets get the same treatment, and that tells you everything about who designed this law. Stocks, bonds, mutual funds, exchange-traded funds, and crypto are all subject to the annual mark-to-market approach. The tax authority assesses your portfolio every single year and taxes the change in value whether you sold or not. But real estate has different rules. For property and qualifying startup shares, the government uses a traditional capital gains approach. You only pay tax on the appreciation when you sell or dispose of the asset. The government's own explanatory memorandum explicitly acknowledged what it calls liquidity risk. If your rental property doubles in value but you haven't sold it, you have no cash to pay the tax bill. So real estate gets the sensible treatment. But Bitcoin? Stocks? Apparently those investors do not face the same problem. This exemption for real estate is not a minor detail, it is a design choice. The The people writing this law understood the liquidity problem perfectly and chose to ignore it for certain asset classes. The investors most exposed are retail investors, crypto holders, and anyone with a concentrated equity position. Exactly the people with the least political power in The Hague. Here's where it gets truly dark. The liquidity trap. Imagine you bought Bitcoin in 2022. By 2028, it's worth 4 times what you paid. You believe in the long-term thesis. You never sold. Under this system, every single year, you owe 36% on that year's gain. If Bitcoin went up 20,000 euros that year, you owe 7,200 euros in tax. Not from a sale, not from profit in your bank account, from a number on a screen that could be lower by the time you actually pay the bill. Where does the money come from? You either sell part of your position, which might trigger even more tax and defeat the entire strategy of holding, or you pay out of pocket from your salary. For someone with diversified income streams, this is painful but manageable. For someone who is heavily concentrated in one asset class, which is exactly how many retail investors build wealth, this creates forced liquidation at the worst possible time. Cointelegraph reported that Dutch crypto holders are already considering leaving the country over this. According to De Nederlandsche Bank, indirect crypto investments held by Dutch entities reached 1.2 billion euros by October 2025, up from just 81 million euros at the end of 2020. That's nearly a 1,500% increase in paper gains that are about to become taxable on a schedule that does not care whether you sold or not. Think about that for a second. Now here's the part almost nobody is talking about. This is Europe's first unrealized gains tax, but it may not be Europe's last. Almost no other European country does this. Norway taxes capital gains at realization. Germany applies a flat 25% withholding tax at the point of sale. France, Austria, Denmark. They all wait until you sell. The Dutch model is an outlier, and they know it. Several parties in the current governing coalition have publicly said that taxing unrealized gains is not their preferred approach. They passed it anyway because they needed a legally viable framework fast. An annual budget hole of 2.3 billion euros has a way of accelerating political decisions. The stated goal is to eventually transition toward a realized capital gains model, but eventually has no deadline. Here is what most coverage of this story is getting wrong. The Netherlands is not just changing its own tax code, it is normalizing a concept. If it works as a revenue tool, meaning investors do not flee fast enough, other governments facing budget pressure will file it away as a template. The European Commission is watching. Other finance ministries are watching. The Netherlands did not just pass a law, it wrote a playbook. So, where does that leave you? Here's what you can actually do. First, understand your Box 3 exposure now, not in 2027. If you are a Dutch tax resident, or considering becoming one, map out exactly which of your assets fall under the mark-to-market approach. The difference between holding crypto and holding an investment property under the system is enormous. Second, take the loss carry-forward provision seriously. If you expect volatility in your portfolio, timing your recognized gains and losses across years can meaningfully reduce your tax burden. This requires planning, not panicking. Third, diversify your asset classes with tax structure in mind. Real estate and qualifying startup shares are exempt from the annual mark-to-market approach under the new law. That is not just an investment consideration, it is a tax strategy built into the legislation itself. Fourth, know your exit window. The law takes effect January 1st, 2028. If you establish tax residency in another EU country before that date, Dutch Box 3 rules no longer apply to you. Countries like Italy, Greece, Malta, and Cyprus have introduced favorable regimes for new residents, including flat tax systems, territorial taxation, and in some cases, complete exemption on foreign investment income. 2 years sounds like a long time. It is not. Here is the uncomfortable truth about what just happened in the Netherlands. A government under pressure to replace a broken tax system chose the path of least resistance, not the path of least harm. They chose the quick fix that raises revenue now and lets somebody else deal with the consequences later. Those consequences land on retail investors, crypto holders, and anyone who believed that building wealth patiently, without cashing out, was a responsible strategy. The Dutch tax system is being redesigned in a way that treats paper profits as real income, while real problems such as forced selling, liquidity risk, and investment flight get written off as acceptable side effects. But at least now you know exactly how the trap is built.